Karan, given the carnage that is happening in the market,
Mm-hmm.
there is this one concept which is now often being discussed and thrown around, and I thought that we should do a video to try and make sense of it,
Mm-hmm.
and that is this whole idea of tax loss harvesting,
Mm-hmm.
right? Um, Firstly, in layman terms, again, I want you to explain what is tax loss harvesting.
See, let's start with this very simplistic example. So let's
Okay.
say you have portfolio of two stocks,
Hmm.
Reliance and Tata Steel.
Okay.
Okay. So Reliance stock price is around 1200 rupees. Now
Hmm.
let's say stock price come down to around 800 rupees.
Right.
Okay.
400 loss.
400 loss.
Hmm.
Only one share is there.
Yeah, yeah,
Okay.
yeah.
Just for simplicity.
Hmm.
And you sell it, book the loss of 400 rupees
400.
and then buy it again at 800.
Okay.
Okay. Now let's say 1 year down the line or 6 months down the line.
Hmm.
Okay, you decide that okay, I want to replace Tata Steel with JSW Steel,
Okay.
Jindal Steel,
Hmm.
basically.
Hmm.
Okay, so now Tata Steel is sitting at gains of 700 rupees.
Okay. From the 800 level.
No, that was Reliance
Oh, sorry.
that you
Sorry,
sold.
sorry.
Okay,
Uh-huh.
now the other share I'm talking about, Tata Steel was another share in the portfolio,
Okay,
two share
okay.
portfolio.
Right, right.
So now Tata Steel you want to replace with JSW Steel.
Okay.
Okay,
Okay.
now market has recovered and everything is well and
Hmm.
everything is there. So Tata Steel now is available. You are selling for 700 rupees profit.
Okay.
Okay, and you are buying JSW Steel.
Hmm.
Okay, so here you booked a law profit of 700 rupees.
Right.
If you had you not sold Reliance at 400, you would have paid tax at 700 rupees,
Right.
right?
Hmm. Hmm. Hmm.
But because you booked Reliance loss at
At
minus
400.
400, okay, now you will be paying tax at 300 rupees.
So your tax liability is only for that 300.
300.
That 400 is set off against the
Set up
loss.
against that loss. So
Okay.
that's the strategically selling
Hmm.
low loss making assets,
Hmm.
okay, turning unrealized losses into realized losses
Hmm.
so that they can be offset against future gains and create significant savings on tax liabilities. So
Right.
that's your tax loss harvesting. In US, it is very popular.
Okay.
Okay. US is so prevalent and so popular that US government has had to bring a wash sale rule. Okay.
Okay. What does that mean?
So wash sale rule basically means if you're selling an asset and you are buying it before 30 days,
Hmm.
before expiry of next 30 days,
Hmm.
okay, it would losses would not be considered. Okay, it's so much
Oh.
popular there. The losses would not be there would be no losses for offsetting. Okay, it will
Okay.
consider the same asset.
So
It's
there
like
is like a
continuous.
lock in almost.
It's like a lock in with. Well, you cannot buy the same asset for 30 days. Okay,
Okay.
it's so much popular. In
Uh,
US, it's popular because in US you can choose which lot to sell. Okay. So, like in, let's say you buy Reliance.
mm,
Okay. Right now, you buy Reliance at 1100.
mm,
Okay. And you buy Reliance again at 1500.
mm,
Okay. Now, Reliance go down to 1300.
mm.
You can, in US, you can sell a lot of 1500. You can select which lot to sell. Okay.
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 Okay. Okay.
In India, this option is not there. In India, we follow FIFO, first in, first out.
First in, first out.
So basically, whenever you are selling, you will be selling the oldest lot, the one which was bought first. Mostly that would be in profit.
Right.
Okay.
Right.
So in general, you have to get rid of entire holding.
Mm,
Okay.
mm.
If your entire holding is in loss, yes,
It makes sense to
it
do
makes
that.
sense to do that. Okay. Otherwise, it's tax loss harvesting potential is quite difficult to materialize in India.
Yeah.
To basically realize the gains from that is bit complicated in India due to this FIFO rule. Okay, but right now the way that we are sitting in market and if you look at the most of the asset classes, segments of the market or even the funds, almost 1 year, almost all gains that
Mm.
have accrued over the last 1 year
Has been erased.
has been erased.
Yeah.
Okay, so if you realize some of those losses, they can be used
Mm.
in the during future when you are basically going for profit booking.
Right.
So whatever losses that you are making, let's say short term, you are booking short term losses.
Mm.
Okay,
Mm.
short term losses are for assets which have been held for less than 12 months.
Okay.
Okay,
Mm.
so short term losses can be offset against any gains. There are carry forward advantages there.
Right.
It can be offset against any gains,
Mm.
basically capital gains,
Mm.
long term or short term for next
Right.
8 years. Okay.
Okay, okay,
So let's
okay.
say you bought an asset in
So
July.
it's almost like that becomes a tax credit,
Yeah,
almost like a tax,
it's like a tax credit.
which you can carry forward for almost 8
8
years
years.
to book against any of the profit.
Any of the capital gain.
Right.
Capital gain. Okay, long term or short term. In case of long term losses, it can be offset against only long term gains, which is
Okay.
also sizable because it also can be carried forward for 8 years.
Right, right.
Okay.
So as a domain expert, would your suggestion be to people right now sitting in
Mm-hmm.
early March
Mm-hmm.
25, would your suggestion be to look at your portfolio, see where the opportunities lies? Because like you said, genuinely almost 80-85% of the situation right now is that there is a loss
Mm-hmm.
that has occurred over the last 1 year or so. So if there is a short term loss booking opportunity, then one should avail of it.
Yes, the problem is in general, people see
Mm,
somehow, I
mm,
don't know why this is the case, but in general, people see realized losses as kind of a bad thing as compared to unrealized losses. Realized losses are actually assets.
right.
Okay. And it's you can also do like for like replacements very easily. So
Mm,
let's say you have some large cap index funds are there.
mm,
Some 40 funds are there.
mm.
We are tracking Nifty 50. If you sell one and buy another one, there is basically zero timing risk that is there.
It's an exact one for
It's an
one.
exact one for one replacement. If there are some shares there, you can buy a similar share
Mm,
and from the same sector. So you can, if your TCS that is in loss, you can basically sell it and buy Infosys.
right,
Okay.
right.
So when you are one thing has to be considered when you are going for tax loss harvesting, you should remove timing risk from the picture. Okay.
Mm,
Always use proceeds to take position immediately. Ideal scenario is putting new money
mhm.
and taking old money out. Okay.
Right, right.
Taking new money and buy it, but buy a different asset, or you have to wait for 2 days. Okay.
Okay,
Wait for
okay.
2 days. At T plus two, you can buy again same asset as well.
Right,
Okay.
right.
But
So basically, you're saying that if you delay re-entering or rebuying an
you
asset,
are introducing timing risk.
timing
You are
risk.
introducing timing risk. Your market might recover, stock might recover. You might be losing out on returns. So
Right.
it's always better to identify a like for like replacement
Hmm.
and go for it.
Got it. Got it. Got it. Got it. Got it. Or at least where the correlation is pretty high.
Yeah, correlation is one metric that can be used. Okay,
Right.
though
Right.
correlation also changes very often. Okay, so it's better to look for sectoral the companies which are in same sectoral space or
Right.
business mix is quite similar.
Hmm.
Okay,
Hmm.
like for if you're going for ITC, it's very difficult to replace it with somebody in Indian market, something in
Right.
Indian market.
Right.
Okay,
Right.
but if you are going for let's say Infosys or HCL, you can find some replacements which are there.
Right. Right.
Yeah.
So would the right step of implementing this entire tax loss harvesting would be first to look at your portfolio and see where there are those sizable genuine losses
Mm-hmm.
that are available.
Mm-hmm.
Then look for like to like replacement
Mm-hmm.
of what if you sell this, what is the asset that you actually buy or
Buy.
security that you buy in return of
Mm-hmm.
it. Then you book those losses, buy the other asset,
Mm-hmm.
and create those
Tax
tax
assets
credits for the
for the
long term.
for the long term,
Right,
and you have 8 years to cash on them.
right. If it is a short term loss.
Even in case of long term, you have 8 years to cash on that. It's just that the short terms are offset against both long term and short term
Right.
gains. Long term losses are offset only against the long term gains. That's the
Great,
only difference. But they can be also offset again.
great, great. So, thanks a lot.
Mhm.
So, in case you want a further deep dive into even thinking about how to optimize your portfolio and what is even the right portfolio to have as an investor across your different life stages, then we have deep dive discussions on those subjects. There is a link in the description. Do check it out. Thanks a lot, Karan.
Thank you, Santosh.